Hello class, this is Dr. Fenton. In this video, we are going to talk about Chapter 10. Now Chapter 10 discusses a concept called capital investments, which deals with very important concepts. Now these concepts can be very difficult to understand the first time through, so please review this video several times and read the chapter very closely. Let's get started. Now, capital investments are investments that are long-term. They're usually large items of equipment. They could be buildings and so forth. So usually you're talking about a lot of money for an asset that will last many years. Now, the asset will generate, hopefully, some profit, some revenue. And so we're going to find a way to see if before we buy it, is there a way for the capital investment for that asset to pay for itself over its useful life? A concept introduced in this chapter is something called the time value of money. Now, you can see the highlight I have here in green. They say the time value of money recognizes the present value of a dollar received in the future is less than a dollar. Well, that's a little bit confusing. I wish they would say it something like this. The present value of a dollar received in the future, like 1 or 2 years from now in the future, that dollar received in the future is worth less than a dollar today. So really they should have the word today at the end of the sentence. Now the reason I skipped this example here, I did not think it was that great of an example, so I did not want to go through it. I wanted to go straight to the important part here. Now, the reason a dollar in the future is worth less than a dollar today is because if you had a dollar today, you could at least earn interest on it. I know the interest rates today are not very high, but at least it's a little bit. So you can earn a little bit. So like in a year or two from now, whenever they offered you that second dollar in the future, then you would have more money if they gave you the dollar today than give you $1 in the future. You'd have more money, therefore today's dollar is worth more because you could at least earn interest on it. Also, there's a risk involved. If you're promised, I'll give you a dollar today, that's guaranteed. A dollar in the future, even though they're promising that, that's not guaranteed. Something might happen, so it's a risk you might not collect it. Also, a reason why a dollar in the future is worth less than a dollar today is inflation. Whatever you can buy for a dollar today, if you go a year from now, 2 years, 3 years, you're not going to be able to buy the same item for a dollar. It'll cost you more just due to inflation. They talk about return on investment again. We saw that in an earlier chapter. Now, minimum rate of return. We need to talk about interest rates in this chapter. It's going to be quite a bit talking about it. And the rate we're going to use is something called the cost of capital. And the cost of capital, as you can see here, represents the minimum rate of return on investments. In other words, what return must you earn on an investment to put your money into that investment? So you analyze the investment. If it doesn't make your threshold, your minimum rate of return, you would not invest your money in that investment. You would invest it in another asset. Now, the minimum rate of return has several different terms. It means it's all the same thing. Required rate of return, the hurdle rate, the cutoff rate, or the discount rate. That all means the same thing. From this point on, in this chapter, we're going to use the term desired rate of return. All these terms mean the exact same thing. So someone else might call it minimum rate of return, required rate of return, hurdle rate, cutoff rate, or discount rate, or desired rate of return. It all means the exact same thing. You can look at this real quick, and which one of these alternatives would you rather have? Someone says, I'll give you $2,000 this year, $3,000 next year, $4,000 in year 3. You'll get $9,000 total by the end of year 3. Alternative 2, they'll give you $4,000 today, $3,000 next year, and then $2,000. Still the same total, but wouldn't you rather have the most money the earliest? Yes, you would. And again, it deals with the time value of money. The money early on is worth more money than in later years. This example is okay. I don't care for it too much. You can read through it yourself. I want to get down to using the tables. Now, let me go straight to this table here. What we need to do in this example is to find out what are these 4 $200,000 payments out into the future, this year and 3 more years out to year 4. Each year there is a $200,000 cash inflow. What is that worth in today's money? In other words, what is the present value of these future cash inflows? Again, what is the present value, one number, what's the present value of all of these cash inflows going 4 years out? In today's money, what's the present value? You can see they're taking $200,000 that's being received every year times a factor. We're going to see where we get this in just a second. Once you know what factor to use, and as I said, I'll explain this. Once you find out this factor, multiply period 1's cash flow by the factor, and you have the present value equivalent of $178,571. That's at the end of year 1. This cash comes in, so we're talking about a year later. Let's say it's January 1st this year, and you're going to be paid this on December 31st. So you've gone all through year 1. Into period 1, you received $200,000. On January 1st of this same year, period 1, it's worth $178,571. So period 1 payments are made at the end of period 1. The period 2 payment, $200,000, that's another $200,000 coming to you, but it's 2 years away. What is that $200,000 payment 2 years in the future worth today? We have another factor, and you can see it's a little bit lower. It's worth less money. Do the same thing with period 3 and period 4. These are the present value amounts for each of those payments. You can see it declines as it goes out into the future. But altogether, those 4 $200,000 payments 4 years out in today's money, one lump sum today, January 1st, this first year, period 1, it's worth $607,470,000. $607,470. Okay. Now, I need to show you where these factors come from. So I'm going to be jumping around a little bit. They talk about right here, appendix table number 1. This is a present value table. This lets you calculate these present value amounts very quickly. So what we need to know are two things. We need to know the discount rate we're using, 12%. I call it the discount rate. They were calling it up here, the desired rate of return means the same thing. I always usually say discount rate. So we know the discount rate is 12%. Then we have to know how many periods we're dealing with. Well, the first payment, end of period 1, second payment 2, and so forth. So we're going to go to a table, look up 12%, and then look up the number of periods to get each of these factors right here. Let's go to the table. Let's click here. Here we have the present value of a dollar table. And you need to know the discount rate in the form of a percent, 12%. And then for year 1, these are period. End is a period. End of period 1, 12%. There's your 0.89 and other numbers there. That's where they got that number. End of the second year, period 2, 12%. There's the 0.79 and some more numbers. Period 3, 0.71. Period 4, 0.63. To look up a factor in this table, you must know your discount rate, minimum rate of return, 12%. You must know the number of periods you're dealing with. One payment is in period 1, another payment is in period 2, and then 3, and then 4. So I'm going to go back to where we were. I'm going to use this here, and I have to scroll down to where I was right here. Those are the factors. So again, one more quick explanation. You can find the present value. In other words, what are those future payments worth today? So if we're sitting here, let's say January 1st, in year 1, I'll call it period 1, and the first payment is made at the end of period 1, 12 months away, that present value is the $200,000 they're going to give you in the period, into period 1, times this factor. So in today's worth, the present value is $178,571. Another payment of $200,000, 2 years out, is worth a little bit less. You got year 3 and year 4, and period 3 and period 4. Now the reason these are worth less is because you have more time to take that money and earn a return on it. Okay, so if you had the money in your hands today, you can invest it somewhere and earn it, and have that future value out there at the future at the end of period 1, 2, 3, or 4. Okay, so anyway, I hope you understand this. Now there's a quicker way. If we have equal payments every period, equal payments, then we don't have to make 4 separate calculations. This is called an annuity. So present value table for annuities. So if we have 2 things going on here, equal payments per period, and the discount rate is the same per period, we can go to another table, we'll see in just 1 second, take one number, one multiplication, and get the same answer. They're doing that right here. So instead of 4 separate calculations, we can get a factor from another table, we'll look at table 2 in a second, that when you get that factor, 12% for periods, it's an annuity, then multiply once and you get the very same answer. So you can do it year by year, or you can do it with one calculation. Let's look at Appendix 2. So we're going to be looking for 3.037349. Remember, 12% for periods. This is an annuity. And the definition of annuity is same amount every period. Here we go. Table 2, present value of an ordinary annuity of $1. We talked about 4 periods. We talked about 12%. There's your number. If you're working with an annuity and you know you can go to the annuity table, don't add up each of these numbers. This 3.03 and some odd numbers, this is the accumulation here to the first table, 12%. Add this, 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 and this. That gets you that number. So don't add these. If you have an annuity, same amount per year, the cash payment, same discount rate every year, there's one calculation. Get this number, multiply it times that annual payment. Let's go back. Scroll down, and that's where we were. Okay. So let's see. Software programs can calculate this. Some of your handheld calculators can do this. I'm not going to get into Excel and show how to do this because we have the tables. It'll be much easier. And you'll be using the tables on the exam anyway. Talks about the ordinary annuity. And you can read that assumption there. Equal amounts, same time of the year you're receiving it, and so forth. Same rate. Reinvestment assumptions. This example, read it on your own. You're not going to be tested over this example. It's sort of explaining all this, but they really get down into a lot of detail, and they tend to make it a little bit confusing. So let's go to the next page, see what we have. All right, now that we know a little bit about time value of money, let's see if we can analyze these investments to see if we need to put our money into these various assets. Net present value. Okay, now the process for the next several pages will be something called capital budgeting. So a capital budget is showing your major investments. These investments will last several years. And so you need to evaluate them before you lay out your cash today for that investment. And we saw earlier where $200,000 per year for 4 years equals to a $607,470 amount today. Okay. So let's look at this. The present value of that example we saw on the previous page, $200,000 per year, 4 years, 12%. The present value is $607,470. If that investment only cost us $582,742 today, we have a positive net present value. So the present value of all those future cash inflows is greater than what your cash outlay is today. In other words, this present value amount you're paying out today. So if you pay your hard-earned money, $582,000 some odd dollars out today, and that investment will generate $200,000 per year for 4 years at 12%, then it's above your discount rate because it's a positive net present value. So you probably should make this investment. So you're looking for a positive net present value. If this is negative, that means that investment is earning less than your discount rate. In this example, less than 12%. But since this one is positive here, this is earning more than 12%. Next page. To measure cash inflows, there are 4 different sources here. You're looking at an asset. If you purchase that asset, it will generate revenue. Okay, so if it generates incremental or differential revenue, we talked about that in an earlier chapter, that is a cash inflow. So incremental revenue refers to additional cash inflows from operating activities generated by using additional capital assets, the one you're thinking about buying. So revenue we're looking for. Also, cost savings. If you buy the new asset, it might require less raw materials cost, fewer repairs, maybe less electricity or whatever. Any cost savings will mean cash not going out the door. We treat that in this area as another cash inflow. Salvage value. If that asset, maybe it has a useful life to you of 5 years, if at the end of 5 years you predict, and again this is an estimate, you predict you can sell it for a certain amount of money, that's going to be a cash inflow. You're not going to get that cash inflow until 5 years in the future, one lump sum, but it would go into these computations as a cash inflow. And then working capital. Working capital will be cash, receivables, inventory, those kinds of things. Sometimes you have to increase working capital when you purchase a certain asset. So if you buy an asset and that causes you to be able to reduce the amount of your working capital, you have that amount of money not tied up in working capital, the reduction of it, that's another cash inflow. Now cash outflows, 3 categories. The first one, your initial investment. That's the big one. What's the amount that asset is costing you today? Is it going to be $100,000, $200,000, $500,000, whatever? That's usually one of the biggest numbers here. So your initial cash investment today in today's dollars, what is it? That's a cash outflow. The 2 others are just the opposite of the ones we had here. Cost savings and reduction in the amount of working capital. So if you buy the asset and it causes you to increase operating expenses, that's a cash outflow. That increase in your operating expenses would be a cash outflow. If it causes you to tie more money up in working capital, that's a cash outflow. So you're either going to have increases in working capital commitments or a reduction, or you're going to have cost savings or extra cost in operations. Okay. So here's a little summary of this. Inflows, revenue coming in, cost savings, salvage values, recovery of working capital because you can reduce the amount of working capital that you have. Inflows. Outflows, that big initial investment, incremental expenses, if you buy it and expenses are going up, and then additional working capital commitments. Those are cash outflows because they're going to tie up more of your cash. Let's take what we've learned so far and see how to use all that to analyze different investment opportunities. In this example, there are two opportunities. One is to modernize the maintenance facility. The other is to purchase a truck. Let's look at all the numbers here. Now, net present value is what we're going to use. We used this in the previous page. The same term means the same thing. Now, this schedule is a little busy here, a lot of numbers, but it does cover most topics we're talking about. So let's see how this works. Alternative number 1, to modernize the maintenance facility. We did the analysis and thought if we modernize the facility, things will be more efficient. We're going to have cost savings then of $21,000 per year. And let me go back up and see, we're talking about for 5 years. The equipment will be modernized for 5 years. And the rate of return is 14%. So the rate of return that they desire to earn is 14%. So we're looking at 5 years, 14%. Go back to the schedule. So cost savings, $21,500 per year for 5 years at 14%. Go to the tables we looked at earlier. This is an annuity. This is a savings per year. So the annuity would be 5 years, 14%, 3.433081. Multiply that. The present value of these cost savings, which are cost inflows, cash inflows, the present value is $73,811. Salvage value, we could sell the machine at the end of 5 years, one lump sum, $4,000. So go to the present value of a dollar table, 14%, 5 years in the future, 0.519369. Multiply, that present value is 2077. Now, make sure you use the correct table. This is an annuity. Use the annuity table. This is a lump sum. Use that present value of $1 table. Not the annuity of $1, but the dollar table. Now in the working capital, it's a little bit different. We have to go back and read this closely. The $12,000, this is working capital recovery. That means we can reduce some of the working capital accounts. But up here in the reading it says, where is it? Yes. The company's accountants believes that by the end of the first year, the carrying value of the small parts inventory could be reduced by $12,000. So it's the end of the first year, not at the end of the useful life of this asset. So $12,000 is going to be taken times the factor for the present value of $1, one lump sum, table number 1, year 1, 14%. So this is not an annuity, and this is not a lump sum at the end of the useful life. This is at the end of year 1. So make sure you read everything closely. When is the cash going to be considered cash inflow? End of year 1, end of year 5, or every year in equal amounts. So the present value numbers, add them all up. So the total present value of cash inflow is $86,414. Cash outflows. The equipment will cost $80,000. We get a trade-in though of 5. It's only going to cost us $75,000. That's today, so the present value factor is 1. You don't even look this up on the table. If this money is going out the door today, that's present value today. Training cost. We will incur those immediately. That's cash going out the door today, or almost today, so very, very close. Again, take it straight over. These are not future cash payments, cash outflows. These are happening immediately. So they come across here. So this is your net present value of your cash outflows, total. Put them together. Cash inflows, subtract cash outflows. This alternative, this machine alternative, has a positive net present value of $8,414. If this had, again, a negative value, you would stop here and not even consider this. But it's positive, and it's positive $8,414. Let's look at the delivery truck, see if it's any better. Looks like we have revenue coming in each year for 5 years, 14%. Take it times the factor here. There's the present value. Salvage value, lump sum into 5 years. There's the present value factor. And then working capital recovery looks like at the end of 5 years also. And so there's the cash inflow. Add up all the present value amounts of the cash inflows, and the total is $255,061, the present value of all these cash inflows. But remember, the revenue is an annuity, $69,000 per year, 5 years, 14%. Table number 2. Salvage value, one lump sum at the end of year 5. Table number 1, 5 periods, 14%. Working capital recovery. This is different than the equipment up above. This doesn't come in until at the end of 5 years. So go to table number 1, 14%, the 5-year period. Cash outflows. Well, there's the cost of the truck today. The cost $115 today, bring it straight across. If we type working capital today for 5 years, that's cash going out the door today. Okay. We're getting it back up here. We're accounting for that as cash inflow. It's cash outflow today. Looks like we're going to increase our operating expenses with this truck. So $32,000 per year, an annuity, times the factor for 5 years, 5 periods, 14%. 109,859. And then the major overhaul will be, let's see what they say about the overhaul. We're going to have a major overhaul. Looks like at the end of year 3. Okay, $20,000 will be paid out at the end of year 3 for the overhaul. Go back down here. The way to handle this, here's the $20,000 overhaul, end of year 3. One lump sum going out the door, one time, end of year 3, 14%, table 1, there's the factor. Multiply, add your total present value of your future cash outflows, today and future, $243,358. Compare the present value of your inflows to the present value of your outflows, and the net present value is $11,703, which is a little bit higher than buying the equipment. You have a higher net present value with the truck. So you might say, all right, I'll stop here. This is my decision. And that's fine if you want to. Another way to evaluate these numbers, the same numbers, we're going to look at, let me just show it to you first. It's called a present value index. So for alternative 1, the equipment, you'll divide the present value of your cash inflows by the present value of your cash outflows and get an index figure. Look at this one, alternative 2. Present value cash inflows by your cash outflows, divide, get the factor. Here the factor's higher because the investment's not the same. Okay. Now, when we boiled it down to net present value, the truck was higher. Value of the cash, present day value of the cash is higher than the equipment. But when you take this number, cash outflow, divided by this number, cash inflow divided by cash outflow down here, present values, you got that one factor that was higher than the factor for the truck. Taking this net cash inflow divided by your net cash outflow, here's the result. So you might make the decision based on this. Again, the company decides what it wants to use to make the decision. So here are 2 different ways of making a decision whether to invest in an asset. Either you're going with the highest net present value, which would be the truck, or the highest present value index. The decision is yours. We just looked at one method used to evaluate investments and assets. That was called the net present value method. Here's another one called the internal rate of return. What we're going to do here is not worry about our minimum discount rate to go find the net present value. This is not that method. We're going to compute this assets, this investment's rate of return that it's generating, and compare that to our own discount rate, our own minimum rate of return. How do we do that? Well, the example they give here relates to an earlier example I sort of skipped over a little bit, but they give us the relevant numbers here. If a rental company wants to buy some projectors, and those projectors would cost $582,742, but it would generate $200,000 per year for 4 years, then what we'll do is, if you want to make sure that the net present value is 0, your cost would equal to your present value, net present value. So this is not the net present value method, but they would just say your cost, right here, divide by the annual cash inflow, net cash inflow, and you get a factor. Now we take this factor, go to the table, and find the percent. So what we'll do then is go to table 2. We're going to be looking for the 2.91371. We're dealing with 4 years. Okay, it's a 4-year return from this investment. So we're looking for this factor, present value annuity table, 4 periods. And let's find the percent. Go to the table, and here it is. We're going along the 4-period line, 4 years, 4 periods. We're looking for 2.9 something. Well, we don't see it yet because I have to scroll down. So we're going to be at the 4th period. Scroll down and then bring that across. Okay. We go back up. Here we are on the 4th period line. We're looking for 2.913712. Here it is. What this means is this project, this investment will generate 14%. Okay. A minute ago, when we were looking for net present value, we evaluated it. Did it have a net present value that's positive? If so, it was above 12%. Now what we're doing, we're using the factor to the table to find the percent. So 14%, let's go back to that page, scroll down, and here we are, 14%. It's above the desired rate of return of 12%, then that would lead us to go ahead and make this investment. So internal rate of return is fairly simple. You just take your cost, divide by the annual, it must be annual here, the same amount annually, get the factor, go to the annuity table, find that factor along the period line that you're working with. In this example, it was 4 years, 4 periods. This part down here, calculating the internal rate of return when the cash flows are distributed irregularly, don't worry about it. So you can read this, you can read this, sort of the same thing we talked about, and don't worry about tax considerations. Okay, look at the next page. There are other ways to evaluate these investments. These methods on this page do not use the time value of money concept, so no present value, future value kind of things going on here. Payback method, fairly simple. The easiest one, there are 2 different payback methods here. The easiest one is take the net cost of the investment divided by the annual cash inflow. So if you have an investment that costs $100,000 and it'll reduce labor cost or have cash inflows, either way, by $40,000, divide, that means you'll recover your investment in 2.5 years. It completely ignores discount rates. It just says, how quick will I get my $100,000 back? So again, $100,000 is your investment today. It'll generate $40,000 per year. Divide 2.5 years, you got your money back. Unequal cash flows, a couple different ways to do this. It's still a payback period. If you have a machine that'll cost $6,000 today, and it generates $3,000 year 1, $1,000 year 2, then $2,000, $1,000, $5,000, it's unequal. You cannot make it a nice, quick division and get one number. What you can do, though, is say, all right, in year 1, I'm recouping $3,000. In year 2, I'm getting another $1,000. I'm up to 4 on the return. Year 3, another 2. It gets me to 6. I have my original investment covered. That means my payback period is 3 years. Okay, that makes sense. Another alternative way when you have uneven cash flows is to average everything. So take years 1 through 5, different amounts every year, add them all up, divide by the number of years, and use the average of $1,500 per year. If you do that, $6,000 divided by 1,500, 4 years is your return. So here it was 3, here it's 4. Again, it's your choice. Do you want to use the sort of the accumulated method or the average method? It's your choice. Another way to evaluate an investment is use an unadjusted rate of return method. This one again is fairly simple. You'll take the average incremental increase in annual income, net income here, not just cash flow, and divide by the net cost of the original investment. So if you have these numbers, here's a restaurant that will require a $2 million investment, and after-tax net income will go up $280,000. So 280 in your numerator, 2 million in your denominator. Then we have 14%, which is your unadjusted rate of return. Simple calculation. It does ignore, present value, future value, and so forth. It is simple, but it's one more way to evaluate an investment. In this method, that is the unadjusted rate of return based on average investment, don't worry about this one right here. Now, I still want you to know this one. In a fairly simple example, annual net income increase divided by investment. Simple. Don't worry about this one where they average the investment. And that's it on that page. A post audit is just, let's take a look at the numbers after the fact. So you made the investment, maybe it was a 4 or 5 year investment. You did either your net present value, payback period, internal rate of return, or whatever you use, that's fine. But after the time period has expired, at the end of the useful life of that asset, go back and see how accurate you were with your original numbers. It's a post audit. Okay. What this will do, even though there's nothing that can be changed because after the fact, you can at least see if the methods you're using were accurate. If they were not accurate, find out why, and maybe you can make better decisions with a more accurate method in the future. That's really what a post audit is. And then in the text you have your table 1 and your table 2. Again, remember, these are present value factors based on your desired rate of return and number of periods. Table 1 is for one lump sum, not an annuity. That's table 2. So one lump sum in the future, what is it worth today? Depends on the number of periods you're going out and the discount rate. Table 2, an annuity, equal amounts every period, not one lump sum. So the same amount every period for a certain number of periods, certain discount rate, there's the factor you use. So try not to get these two tables mixed up. Table 1, one payment, or one cash item coming in, one cash inflow, one time. Table 2, equal amounts every period. Okay. All right, so that's the end of the chapter, and again, go back and read it yourself. It's sort of a long chapter, it's a long video, so spend time on it, read the chapter, go back through the examples, follow the numbers through, and good luck with your studies.